The good old tried and true method, a great way of saving up for retirement and building up investments, of investing a little bit over time. That's a great way to save up for retirement. But is that the way you should withdraw dollars in retirement? Ooh, I got some perspective coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So I'm not a mountain climber. I'm not even a hiker. But I would imagine there are some hikes, there's some mountains, there's some climbs where the path that you climb up is not the same path you should go to take down, okay? And maybe you've probably heard this as well, that sometimes the climb down is harder than the climb up, but is the path that you take up the retirement mountain, the savings mountain, is that the same path that you take going back down when you're in retirement? I would argue no. I mean, the path up is something called dollar cost averaging, okay? I mean, unless at whatever time you want to retire, you inherit a fully built and fully constructed retirement portfolio that works perfectly for you. It's been working for someone in retirement and you inherit it and it's automatically set up to work perfectly for you. Chances of this are, a better chance of getting struck by lightning, but then you're good, okay? For the rest of us, the way you save up is you're buying investments every single paycheck, or hopefully every single month, or at a consistent point along the way. They call that dollar cost averaging, and that's geek speak for when you do that, you're able to buy more shares at a cheaper price all along the way. And when you average out your average price per share that you invested at, tends to be cheaper. Take, for example, you're investing, let's say, $100 every paycheck. Well, when the price of that share or that mutual fund or that exchange traded fund is $10 a share, great, you're able to buy 10 shares at that price. But what if the price drops to $5 a share? Oh my goodness, you can buy twice as many with your $100. But what if that price jumps from $5 a share to $25 a share? Now you're buying fewer, right? You can only buy 4 shares versus the 10 versus, right? So you're buying more shares when you're investing. You're buying more shares when the price is low. Now, if you knew, hey, the price today is 10, by the end of the year, by the end of whatever, it's going to be 1,000, then who cares? Buy as much as you can, right? But we don't know. We don't know. You don't know the future, and you also don't have a big pile of money. Most of us didn't win the lottery and just have a big pile of money to invest in, especially today with the riskiness of the market and all the manipulation from the Fed and all the concerns and issues going on. Even if you did win the lottery, my goodness, or had a pension that you were cashing out and rolling over, dollar cost averaging to me is the wise way to get that money invested, where you're taking a certain amount of money, okay, whether it's $100, $1,000, $10,000, whatever for your situation, and you're investing it systematically, periodically, same time, same amount, every single month or every single paycheck. And that way, as the investments are going up and down, inevitably, you're buying more shares at lower prices, and you don't have to be clairvoyant to do it. You don't have to be a mind reader or know the future in order to do it. You're automatically buying, and that allows you to automatically buy more shares when the price is low. In retirement, you've built up this big savings. You're ready to kiss that paycheck goodbye, start living off of those assets, okay? Now you're pulling dollars out. Do you pull dollars out the exact same way? We call that reverse dollar cost averaging, and it's extremely dangerous. It's extremely dangerous. Why? Because now the opposite is true. You need $1,000 every month or whatever, okay? And when you need $1,000 every month, if the price is high, okay, I don't have to sell that many shares up here to get my $1,000. That's good. Okay, I'm not selling a lot of shares up here. But in order to get my $1,000 when the price drops, I've got to sell a lot of shares down here. So the exact opposite is true in retirement. Reverse dollar cost averaging, you have to sell more shares at lower prices than when they're at higher prices. And that's the opposite of what you want to do. You actually want to sell more shares when the price is high, not when the price is low. So we would argue reverse dollar cost averaging is a terrible idea of withdrawing dollars in retirement. Therefore, the path that you take to climb the mountain is not the path you should take when you're coming down the mountain. Dollar cost averaging is a great way to invest dollars and build up that retirement nest egg. It's a terrible way to draw dollars out of investing unless you can assure me there's not going to be any volatility in the investments that you use. There will be no big ups and downs, and that the market, is just going to continue to go up. Fine. But we don't have those assurances. Certainly even with bond investors or income investors, those assurances are gone. And so reverse dollar cost averaging could be very, very damaging. Where I see this the most is the folks that are investing for retirement in a target date fund. You look and say, well, I want the simple button, I want the prefabricated house, I want the one size fits all diversified target date fund, and I'm not going to overthink it. I'm going to buy into that investment all along as I'm working. Great. All right. Now I'm retired. I'm just going to withdraw that investment every single month to feed my retirement. It's the same principle. It was a great way to climb the mountain. It's a terrible way to get down the mountain. Well, gee, thanks, Wise Money Guy. Thanks, Mike. That's really helpful telling me what not to do. What about what I should do? Well, to us, so take a different approach. If the way up the mountain's not the path you should get down the mountain, well then what's the path down the mountain? Well, that depends on your overall comprehensive financial plan. So I'm not going to try and give you advice here that should supersede or trump what your certified financial planner who's a fiduciary who's doing comprehensive financial planning with you would advise. But an idea to consider is buckets of money, okay? Instead of reverse dollar cost averaging, buckets of money. And to us, I'm not going to illustrate it fully here. I've done videos on this in the past, but to me, this is an extremely powerful principle. All right, here's how much I need every single month in order to live the life that I want. I need X amount. I've got these income sources. I've got a small pension. We've got 2 Social Securities, and therefore the missing link, okay, I need to draw $2,000 a month or whatever from my investments in order to reach my lifestyle goal, reach my income goal. All right, so you take 2 to 3 years of that income need. So you take that $2,000 a month times 24 months or 36 months, I'd have that in very low risk. Very low risk, okay? So you've got 2 to 3 years worth of dollars of income in low risk, very stable, it's not moving with the market, all right? Then that same amount, that 2,000 or so, you fund another 5 to 7 years in medium risk, or I used to say in an income-bearing investment, okay? And I would still hope that that's true. It's just there's not a lot of interest out there anymore, and you got to take more risk in order to get it. But medium risk or income-bearing investment for another 5 to 7 years. And basically, you have the income from that middle bucket paying into that first bucket, okay? So while you're drawing your $2,000 a month out, hopefully you've got income of maybe $500 a month coming in to replenish, all right? And then you've got all the rest of your dollars that you won't need to touch for 8 to 10 years. That's all invested long term. And when those dollars drop in value, you don't panic. You don't worry, and you don't have to sell because you've got 2 to 3 years worth of cash and another 5 to 7 years worth of medium risk investments that have probably been volatile, but they're paying income to replenish. Okay? So when that long-term bucket, the rest of your dollars go down in value, you don't panic and you don't have to sell anything. When they go way up in value and these other accounts are diminishing, you can then lop off some of the growth and replenish some of these other buckets, okay? Does that make sense? And so there's this constant buckets of money based on your purpose, and it's a constant adjustment rebalance of making sure that you've got the right levels in each, but you're not automatically selling when prices are low. You're being strategic when prices are high or when prices are at all-time highs to say, all right, well, let's replenish this middle bucket. No, actually, it doesn't need to be done right now, and you can't get good interest anyway. Let's use our growth that we've seen over the past couple of years, have that replenish our cash dollars. So work with your certified financial planner. See if that buckets of money approach is a wise approach for you, or some other approach of getting income from your investments as opposed to just reverse dollar cost averaging, which could cause you to sell more shares when the price is low, the exact opposite of what you want to do. If you don't have a CFP helping to craft an income plan for you as part of your comprehensive financial plan, you can call one on my team. You can find us online, korhorn.com, that's Korhorn with a K, wisemoneyshow.com, you can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.